Comments made on the following paid commercial program are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time.
Welcome to the Money and Wealth Show. On the program this week, Tax Tips with David Ingram, Money Mercials, and our special guest, Scotiabank Chief Economist Warren Jestin. Welcome to the Money and Wealth Show. I'm Sterling Fox, and our special guest this week is the Senior Vice President and Chief Economist with Scotiabank, Dr. Warren Jestin. Warren, welcome.
It's great to be here.
It's good to have you in Vancouver and on our program. You've predicted economic growth for Canada in 2010 of 3.3%. That was about a month ago. Any changes in the last 30 days?
No, we're pretty confident that the type of growth that we're projecting is going to be realized. In fact, it may be a little higher. We started off the year very strong in some places. A lot of it has come from government spending, inventory rebuilding. The auto sector is ramping up. Sales have been pretty strong. In Vancouver, Lower Mainland, you've got a very vibrant housing market. The Olympics, of course, added quite a bit of growth. Even in the GTA area around Toronto, there's a lot of basic activity in some sectors, the car sector and real estate. So at the end of the day, I think you can generate those growth rates. The big issue, of course, is when interest rates start going up, when inventories are rebalanced again, and when governments start to cut back, what sort of growth we're going to get out of it. And I think in that sort of environment, growth in 2011 and perhaps 2012 will be slower than we're seeing right now.
Now, I saw a prediction also of yours, or at least attributed to you, that said interest rates are likely to be at least at 3% by the third quarter of next year. Do interest rate increases inhibit national growth?
Well, the rise in interest rates that is the key, of course, is the Bank of Canada. Bank of Canada, our central bank, tends to move interest rates up when the economy is going and it gets worried about inflation. Right now, their rate, the one that they have set, which forms the foundation for interest rates in Canada, is at a lifetime low.
Sure.
And so what we see is the Bank of Canada taking its foot off the accelerator starting in June or July and raising interest rates slowly but steadily over the next year and a half or so. And so you go from 0.25 percentage point, again a lifetime low, to something around 3% by the end of next year. And that, interestingly enough, would leave interest rates still low historically. Now, in the real world, what that means is variable rate mortgages go up. And if bond yields go up, you would find that 3- and 5-year mortgage rates go up as well. So the take-home message in our forecast is that as the Bank of Canada raises rates and longer-term interest rates go up, you would expect to pay more on your mortgage, whether it's variable rate or the longer terms 3 to 5 or even beyond.
What will that do to the availability of capital for individuals or corporations looking for funding to advance their enterprises?
No, that's a very good question. We've got the strongest banking system in the world. And one of the things that has allowed us to do is continue to increase credit. In the U.S. and in the U.K. and in many other places, the ability to get credit has been a lot tougher. If you're trying to finance a house in the U.S., it's a whole lot harder than it is to finance it in Canada. But the cost of credit goes up, whether you're in a household or a business. Moreover, globally, a lot of regulators are talking about making it tougher to get loans, making it more expensive to get loans. And that comes about because they're talking about making banks hold more capital. They may be talking about taxes in certain countries on their financial institutions. They may be talking about changing the way banks lend money. In the U.S., for example, today, if you go in and say, no, I have no money down, I've got no principal payments that I want to put on my mortgage, and by the way, I can't prove I've got income to support the loan, you don't get it. The funny thing was, 3 years ago, you were a subprime borrower,
That's right.
and they
No
gave
problem.
you the money.
Sign here. Yeah.
So that has changed too. So I think in general, credit is a little tougher to get if you are a riskier borrower, and certainly the rate side is pointed one way, and that's up.
Does the unnaturally low interest rate environment in which we live lend itself to the sorts of predicament millions of Canadians now find ourselves in, which is record high levels of personal debt? How do we sort of come out of this unnatural low interest rate environment with this staggering load of personal debt already into an interest rate increase that is going to make life extremely uncomfortable for a lot of folks?
Yeah, and that's an important point, because if you focus on the debt side, debt has been going up steadily, but it's been going up steadily for 20 years. And the real issue is debt rather relative to your capacity to pay, and what's happening on the other side of the books, on the asset side of your balance sheet. And for many people, while debt has been going up, they also have homes. And they've been paying down mortgages. Unlike the U.S., we have added to home equity in Canada. And unlike the U.S., home prices have not gone down. So in a financial sense, I think whether you're looking at the capacity to pay debt or the asset side, the housing side of the balance sheet, you tend to find that Canadians are much better off than south of the border. Another thing, of course, too, is we're adding jobs on this side of the border. We've already regained 2/3 of the jobs we lost in the recession. The U.S. is less than 10% back on the road to recovery there. They've lost almost 8.5 million jobs, and they're just now beginning to fill in that hole. So whether you're looking at ability to earn through employment, the capacity to pay because of your income relative to the debt load involved, or the assets you own, we're in a whole lot better shape than south of the border.
You're watching the Money and Wealth Show. Our special guest this week is Scotiabank Chief Economist Warren Jestin. He just mentioned housing and real estate, and we'll get into that at length after this break.
My name is David Wolfen. I'm the president of Avino Silver and Gold Mines. Avino owns 100% of the historic Avino mine in Durango, Mexico. Mining dates back over 500 years, and under our control, we mined it for 27 years. We're starting on a new era of mining, and we plan to reopen the mine this year. Avino trades on the Toronto Venture Exchange under the symbol ASM. For more information, call 604-682-3701 or visit the company's website, www.avino.com.
Good afternoon. My name's Larry Ray. I'm the president and CEO of American Manganese, Inc. I'm here to tell you today that American Manganese could possibly bring in the lowest cost electrolytic manganese metal mine in North America. It'll be the first one in the past few decades. What is manganese? Well, you can't have a steel industry without manganese. If you don't have manganese, you don't have steel. If you don't have steel, the world stops. North America has no manganese. We depend on our neighbors and other countries to import our manganese, and it just doesn't make any sense we don't exploit the resources in our own country. So I'm here to tell you that we are moving ahead with the feasibility study, we're moving ahead with the environmental studies, and we're moving ahead with a massive drill program in order to build the American Manganese, Inc. into the first primary electrolytic manganese producer in the United States. Please visit our website at americanmanganeseinc.com or call us at 604-531-9639. Thank you.